abating inflationary fears, a strong earnings outlook, and stronger than expected economic releases drove global equity markets higher in May. International shares were up 1.19%, whilst Australian shares returned a solid 2.31% for the month. At the sector level, the technology sector performed well after a weak performance over the past few months, while financials also performed well. Other asset classes of noteworthy performance included emerging markets, up 2.11%, and global REITs were up 1.52%, continuing on from their recent rally over the past 3 months, up 12.39% over that period. The much anticipated US inflation's data point surged to a 13-year high. The US's strong economic rebound pushed consumer prices to 5% higher than a year ago. Global equity markets appear to have shrugged off this spike in US inflation, suggesting that these inflationary pressures are perhaps temporary. Taking a closer look at the reasons for the spike in inflation, this was driven by factors such as spiking commodity prices, which appear to have subsided in recent weeks. The US labour market added an impressive 559,000 jobs in May. The US unemployment rate fell further from 6.1% to 5.8%. Similarly, Australian unemployment rate also continued to decline through the month of April, falling to 5.5%. Australia's Q1 GDP surprised on the upside. Australia's GDP growth rate came in at 1.8% for the March quarter. This was materially better than initially anticipated. Australian economic activity has recovered to be above pre-pandemic levels and has grown 1.1% through the year. In light of Victoria's lockdown 4.0 over recent weeks, this may have some negative impact on Australia's GDP growth rate for the June quarter. Chinese composite PMIs, a measure of manufacturing activity and a good indicator of economic activity, fell to 53.8 in May, from a 4-month high of 54.7 in April 2021. In the US, manufacturing PMIs and the services PMIs have both bounced to 61.2 and 64 respectively, remaining near all-time highs. Australian manufacturing PMI data rose to a record high of 60.4 in May, from 59.7 in the previous month. However, its services PMI dipped to 58 in May. And now on to our outlook and investment strategy. We still hold the view that we expect shares to keep grinding along and generate reasonable returns over the short to medium term. We might look back in the future and reflect that the current environment to own shares could be one of the best. Supporting our outlook for shares is a strong, momentum-driven global economy, solid company earnings, elevated savings and pent-up demand, along with low interest rates for at least another 2 years, and the US's sizable stimulus packages. We still anticipate more upside potential in the cyclical sectors. Global equity market valuations are above long-term averages, but below all-time highs. Elevated equity market valuations appear to be a critical factor in downward trending markets rather than in equity market rallies. Global equity markets are vulnerable to a pullback, given they have surged. Small caps should continue to rally, supported by a lower interest rate environment and an improving outlook for Australia. Our long-term view on emerging market equities remains positive, supported by relatively higher growth rates than developed equity markets and attractive valuations. We continue to expect the Australian dollar to continue its journey upwards and benefit from the upcoming commodity supercycle. We maintain our strategy of hedging most of our foreign currency exposure.